Hiya, I'm Elliot from Free Life Financial, and in this video I'd like to explain income protection in a way that's super simple and easy to understand. Income protection is an insurance policy which could replace part of your income if you were unable to work due to sickness or injury. When you take out income protection, you'll pay a monthly amount, and this is called your premium. Then, if at some point you were unable to work due to sickness or injury, you could receive a monthly payout from your income protection policy while you were unable to work. When you take out an insurance policy, you'll choose how much you want it to pay you out per month if you were unable to work due to sickness or injury. This is called the sum assured. You might choose a sum assured, which is enough to replace, say, 50% of your normal income, or you might choose a sum assured which is just enough to cover your main household bills. Generally, of course, the higher the sum assured you choose, the higher the premium will be. When you choose an income protection policy, you'll also choose a deferred period. This is the time between becoming unable to work and being able to make a claim. For example, if you chose a 1 month deferred period, you might be able to make a claim after just 1 month of incapacity. If you were to choose a 6 month deferred period, you wouldn't be able to make a claim until you'd been off work due to sickness or injury for 6 months. Generally, the longer the deferred period, the cheaper the premium. If you have sick pay arrangements with your employer, you would take this into consideration when choosing your deferred period. For example, if your employer pays you full pay for 6 months of being off work sick, then you would want a deferred period of at least 6 months, because for that first 6 months, you're still getting paid as normal from your employer. Another thing that you'll need to choose when you are taking out income protection, which will also impact the premium, is how long you were able to claim for if you're off work with sickness or injury. Some policies have a limited benefit period, which means that once you've been making a claim for a certain amount of time, the payments would stop. You would stop receiving the monthly sum assured. For example, if you took an income protection policy with a 2-year limited benefit period and a 6-month deferred period, that would mean that if you were off work with sickness or injury for over 6 months, you would receive nothing for the first 6 months. And after the 6 months, you would start to receive your sum assured. But if you had not returned to work after the 2 years, you would stop receiving the money. Generally, the most suitable type of income protection for long-term cover would be a policy without a limited benefit period. This would mean that if you were unable to go back to work, you could keep claiming the sum assured until either the policy ends or you retire, whichever's first. However, you might have guessed that a policy with no limited benefit period is generally going to be more expensive, have a higher premium than one with a limited benefit period. And that is my brief explanation of how income protection works. Of course, it is very brief, so if you'd like any more info, please get in touch.